Welcome all. Good morning. In this video, let us see what is PE ratio. What is PE ratio? This is one of the fundamental of your company. The company. This is one of the property in fundamental analysis. How is it useful in buying stocks? In general, market experts will look at this whether you can buy a stock or not. Disclaimer, please read this. Okay, let us see what is PE ratio. What P stands for? Company's share price, stock price of the company. Okay. What E stands for? Earnings per share. How much earnings the company has earned per share. Okay. So it is defined as the ratio of a company's stock price to the company's earnings per share. It is given by this formula P by E equal to share price and earnings per share. Okay, let us see with an example. For example, Zomato, its PE ratio is this much. How it is obtained, we'll see now. See, this is the earnings per share for Zomato as given in their report. Okay, this is the earnings per share. This is very small quantity, see, very much. What is the stock price? What is the share price? Rupees 271.75. Let us substitute in the formula to get PE ratio. This is the PE ratio. Now let us see whether the stock we can buy or we can buy. We'll see. What is good PE ratio? What is good PE ratio to buy a stock? For a good company, PE ratio should be equal to 20 to 25 range. But in this case, it is very high. In the case of Zomato, it is very high. So the stock is overvalued and expensive stock according to market expert. From this fundamental, they will say the stock is overvalued and expensive stock because of this PE ratio is higher than 20 to 25. Okay. Now, PE ratio less than 20 to 25. What do you mean? That is, the stock is very cheap. It is undervalued stock. So, you can buy this stock. But in contrary to this, Zomato stock doubled in a year. In most of the cases, it won't obey the fundamentals because people's sentiments. It will follow the people's sentiments. So, although some companies have high fundamentals, very good fundamental, PE ratio, good PE ratio, less PE ratio, but it is not doubled in a year. In this case, Zomato stock doubled because of people's sentiment. Okay, what is EPS? Earnings per share. It is equal to company's profit after tax divided by outstanding shares. In PE ratio, we have used EPS. What is EPS? How it is obtained? It is obtained by using this. It is the ratio of company's profit to the outstanding shares. Now, what is company's profit? You know how much the company has earned profit after tax. Okay, after expenditure, everything. This is the company's profit. Now, what is outstanding shares? The company issues shares to investors. The total number of shares the company issue to investors, brokers, are called outstanding shares. And suppose EPS is very high, that means it is highly profitable company. It earns good profit, it gives good profit, and it is very high. EPS is also called profitability of the company. For example, in the case of Zomato, we have already considered this. Per share it earns only 0.68. Okay, this has got very low earnings per share. Similarly, you can calculate for other companies and see if EPS is good, then the company earns more. It is using the capital for profitability. Okay, thank you for watching. Please subscribe and share. Thank you.